This week I'm going to talk about false breakouts, SFPs, fake outs, bull or bear traps, stop runs, whatever you want to call them, when you have some significant level and price moves past the level but fails to continue. So having exceeded the level, it fails to sustain the breakout, fails to sustain the move. And I've got quite a few examples, most of which are trades I actually took so that you can see exactly where I'm getting in on these setups and why. But I first want to say that I don't really like or identify with any of the terms used to describe this behavior, because there's nothing false or fake about these moves, although you might get trapped. That these are not traps. You're not being kind of hunted by the Dark Lord. Okay. Failed breakouts are nothing more than very normal market behavior. So I'll start by talking a little bit about the order flow dynamics here, because there's a lot of kind of misconceptions floating around. But first off, I want to show you what a good breakout looks like. So you all know that as price consolidates, stops begin to accumulate above and below old highs and lows. And as I've explained, in large part as a result of concentrated stops, market structure, that being major swing points, range highs, lows, these areas act as a kind of a trigger for inefficient price run, some of which will result in a breakout. This is a daily chart on the left, okay, so that you can see the full picture. And on the footprint, which I've got on the right here, what I'm doing is just replaying this section of price action in here, below the highs before this breakout, just so you can see what a good breakout should look like. And what you'll notice is a marked change in which price moves when it starts breaking through these highs. So just note the kind of pace of change here, relatively slow, relatively little going on. And then as it breaks these highs, what you'll see is a flurry of market buying, most of which will be the result of short stopping out. And that will be reflected in a string of zeros on the bid. So there you see a string of zeros as price breaches the 4190 level. And as I've explained, what's happening here is that as these stops get triggered, they're converted into market orders, which will kind of sweep the book, effectively eating up or consuming all of the available liquidity. And you can see that it's as these highs get breached that those stops get triggered, and you get this sudden influx of orders. So there again at 4241, you'll see that when that level breaks, you get another sudden influx of orders as traders get stopped out. And of course, at the same time, you also got traders buying what they perceive to be a breakout, looking for price to extend. Okay, and that's a lot of orders. And so when price breaks out like this, and especially when it breaks out of a consolidation, this kind of prolonged, in the absence of any significant selling, it will naturally run until it hits some liquidity. Okay. So this is what a good breakout looks like. You'll have some significant level, okay, swing high or low, top of a range. And often you'll get some kind of basing or consolidation before the level as buyers, buy limits in here, absorb any remaining sellers up at the range high or up at that swing. So then what you'll often get, what you'll always get, is the initiative in the form of aggressive market buying, followed by a low volume area, okay, an inefficient move, a weak leg in price. And you get that one as a result of the market buying which came in at on the break of this level, as well as the inevitable stop outs. So you get an LVA, a low volume area, which forms because price runs very quickly through this this area on the back of stops, aggressive buying in other words. And as I explained in the first webinar, generally nobody's willing to provide liquidity here. And it varies depending on context, but in this example, which is a good breakout, okay, a breakout which sustains itself, we don't have any significant participants willing to provide liquidity above that key level. And so what happens is the market moves out of balance because there is, in this case, lots of buying and little to no opposing order flow. And so it will, of course, run until it hits some significant liquidity, at which point what you want to see for a good breakout is a kind of shallow pullback, and for price to then carry on up. So basing, initiative, aggression, string of zeros on the bid, short stop out, and breakout buyers buy this up. What you get there is an inevitably low volume area, inefficient price run, but price carries on up until it hits some liquidity, and then you'll often get a shallow pullback and price will push higher. So that's generally what a good breakout looks like. That's what you want to see for a breakout which is going to kind of sustain itself. But of course, depending on context, price can just as easily poke through these highs and fail. And that's what we're going to be focusing on today. So this is quite a nice kind of visual representation of that dynamic, which I posted on Twitter a while back. There was some significant level here, right? And price appeared to break out of that level, and you can see here all this is it's a kind of visual representation of the market buying which occurred in this area. So these blue circles here, they represent market buying of a particular size, so big market buy orders, most of which are likely stops. I can't remember what the threshold was here, but I think it's something like 500k on BitMEX. So anything above 500k, or maybe it was 1 million, that's represented here as blue circles, and the bigger the circle, the bigger the market buy order. So most of these are likely stops, and we know that because of location. Okay, stops tend to accumulate above highs and lows, as you know. And so what you see here is the breakout rush, which you almost always get on a break of a key level. But you can see that there's very little buying just up here, other than those big market buys, most of which are, as I've explained, more than likely stops. And you know there's no buying interest because price retraces this whole move on very little selling. Okay, there are some somewhat significant market sell orders here, but you can see compared to the run up here, really there's very little market buying in this area. So you know there's no real buying interest here, and that the extension, the move here is more than likely just the kind of artifact of market mechanics, artifact of stop orders which take price higher than it should otherwise be trading, and then retraces this whole move on very little selling. And of course, it's not literally a void here. Price retraces on very little selling because there are very few bids in that area, but you'll always get uninformed traders chasing these moves and more than willing to provide liquidity up in here. Okay, but really, in order for a breakout to be sustained, the order book has to be quickly repopulated by large or significant traders. So what some might call informed or influential participants. And you can see they're just not present here. A good breakout requires big bids propping up the market, and in combination with that, a lack of profit taking. So in this case, a lack of significant selling. But of course, if there's no real buying interest up at these levels, once short-term buyers, most of which are stops, once they dry up, price will more than likely just draw back into the relative void which this run has left in its wake. Okay, especially if prices hit some significant sell side liquidity. So let's say we have a range. Okay, pocket of liquidity up at the top, and a pocket of liquidity down at the lows. So those are your flag limits. Okay, let's say price is kind of ranging between these two levels. And so until it breaks out, we consider price to be kind of contained or stuck between these two levels. Okay, but of course, as price consolidates, liquidity at those levels starts to dry up. So let's say price comes down into this base and reacts there before moving back up and testing the highs. As it does so, as it consolidates in this range, it's consuming the liquidity at these levels. And then maybe, let's say, it pushes deeper into this range and then back up and then deeper into this range where it picks up more buys and starts moving back up again. Well, now this area up here is starting to look quite weak. It's been tested 1, 2, 3, 4 times already. We've got fresh buyers coming in off the lows. So at some point, naturally, price is going to start poking through the highs. Because, as you know, price moves to the less liquid side of the market. But if there's still liquidity up in here, let's say there's still some liquidity up at the top of this level, okay, maybe only the bottom side of it got tested. Perhaps there's even a fresh level, a fresh pocket of liquidity kind of resting just above this level. If there's still liquidity there, price will respond. So if there's still liquidity there, or for whatever reason there's no significant interest from buyers, okay, perhaps the the reason that price began to poke above those highs was simply the result of stop loss orders, so no significant interest from buyers, then there's a good chance that price will respond at those pockets of liquidity, and what some might perceive as a breakout is going to fail. And so if all those stops get absorbed, then this quote unquote breakout will likely just collapse back in on itself, and price will simply draw back into the range in search of more buyers. This is why it's so important to take note, not just of these kind of local highs and the lows as well, but of the structure which these highs and lows are kind of referencing. Okay, so this structure here, because that's where the liquidity is. That's the relevant level. So here's a really nice illustration of that on, I think this is gold. So I didn't take this one, but this is exactly the kind of area I'd be watching for failure. So you've got a very clear level here. There's the flag limit, quite clearly the base or pocket of liquidity, which is kind of constraining or holding down this range. And just looking at that, you can see that it's quite likely here that price is going to break through those range highs at some point, because this flag limit's already been tested 1, 2, 3 times. It's gone fairly deep into the level. And so, you know, many people will perceive this as as what they'd call a stop run. And of course, stops do get triggered here, but all this is price reaching for liquidity. Okay. There are no more sellers in this level, and so naturally, price breaches it in order to find some more significant sell side liquidity. And of course, up here, there's a relatively fresh, it's totally untested pocket of liquidity, and as a result, price fails. Okay. The stops which get triggered on a break of these range highs take price higher than it might otherwise have traded. Okay. Price overextends. As a result, there's a void in price. So those two things in combination, the presence of liquidity and this illiquid move, which is the result of stop outs above these range highs, that's what we're looking for. And you can see why I love these trades. As I've explained, that the unusually high volatility at levels like this one here, okay, key range highs or swing points, is quite often just a byproduct or artifact of market mechanics. In other words, this quote unquote breakout is often nothing more than a flurry of stops, a sign of exhaustion. So in this sense, the market kind of exceeds its fundamental value. It overshoots. It's inefficient. And it's these inefficiencies, as I explained in the first webinar, which offer us as traders the best opportunities. Why? Because they leave that void in liquidity. And so as a result, price will often reverse quite violently when breakouts like this fail. So I love these trades because it's really quite rare that you'll find yourself sitting through hours of chop. here's a trade I took on cable a while back now, and you can quite clearly see the setup here for relatively clean or stacked lows, below which is this flag limit, okay, pocket of liquidity, which is quite clearly holding up this structure, this range, this consolidation. In this case, I was unsure or not whether this flag limit still had enough kind of juice for a long here, given that it had already been tested 4 times. But you can see the bottom side of this level is relatively fresh still, so it was an area I had my eye on. And given the approach here, it was very likely that price would at least react at this level, because it's illiquid. It won't take much buying for price to entirely retrace that move. And I'll come on to entries in a bit, but you can see that here I got in long as soon as price started reversing here with a stop at the lows. And that was the outcome. Price moved very quickly to target, and more often than not, you are going to get a momentum move here. And there are a couple of reasons. The first being that when price breaks out here, or appears to break out, it's going to attract fresh attention from short-term traders looking for the extension. So looking for price to sustain the breakout. And of course, when that breakout fails to follow through, they all start kind of scrambling for the exit. So anyone caught on the wrong side of the market now has to get out of their position. Okay, so anyone short there now has to buy up the market, and the result is that price very quickly moves to target here. So a quick buyback, which is also exacerbated by technical traders like us who watch for this kind of price action and will look to get in after the market's kind of shown its hand, just like we're doing here, looking for the unwind for a breakout shorts to get out and long the market. The other reason, of course, is that as a result of the stop loss orders at these lows, you're often going to get this overextension, this illiquid move. And when you get a move like that in combination with the presence of buyers, that will very quickly get filled in, okay? Because there are no sellers in there. The only reason price is down here is as a result of the stop loss orders which were resting underneath each of these lows. Not the only reason, of course, but that they play a large part. So when I'm watching for these trades, I'm looking at levels where I expect that concentration of order flow. I don't have the screenshot here, but this is a trade I took on USD CAD a while back, and again, you've got a very attractive level for breakout traders, and more than likely, of course, a build up of stops. So I think this is an hourly chart, so it's a relatively long or substantial range, and because technicals which appear on the higher time frames will naturally attract more interest, more order flow, the best levels are also going to be significant range highs or lows, so levels with multiple touches, higher time frame swing points, levels which take time to form and which are visible on the higher time frames. And in particular, and this is really important, I'm looking for highs or lows beyond which there's also a relatively fresh or untapped liquidity base, in this case down here. So that's what I'm looking for, some significant structure, preferably visible on the higher time frames, below which you're likely going to get a cluster of stops and the presence of breakout traders, short-term traders, beyond which is fresh, untested liquidity. So That's what I'm looking for, as opposed to, I guess, something like this here. Okay, you've got this range of consolidation. You've got the same thing here. A very nice level, clean highs there, 4 or 5 touches. So it's a very similar scenario. And again, you've got price running thin into the highs, which is exactly what we want to see. That's something I'd be very keen to fade if there were some liquidity here. But in this case, there's nothing. Okay, you've just got a void. And as a result, you get what appears to be a false breakout here. Price does wick back down below those highs, but in this case, because there's no significant liquidity above those range highs, and it's quite likely that whatever low time frame level which was holding down price here has been washed out as a result of all of these touches. In this case, this just kind of represents the consumption of whatever liquidity was left in this level. Not visible here, but likely present on the lower time frames. Okay, so you really want to see something quite clear. Okay, price clearly paused or consolidated there, ran out without retesting it. You can expect some residual liquidity to be waiting there. Okay, so that's what I'm looking for. I also know exactly how I want price to kind of come into the level. So as always, once I've identified that level, I'm generally going to be watching price on approach. And as I've explained, there are certain kinds of price action which increase the probability of a trade working out, of giving me at least a manageable reaction, so that I'm not afraid of executing as close as possible to where I'm wrong. And one of the things I like to see is, as always, price having to kind of reach or stretch before breaking the level. Here's a nice example of a trade I took on Euro USD. You can see prices kind of cascading through these lows here, cascading through the stops sitting underneath each of those lows, and as a result, it's moving really thin into an area in which we know there's more than likely to be resting liquidity. Sorry, this flag limit. Again, not a level I'd be confident buying as a result of all of these touches, these tests, without an approach like this, because it's that approach, it's that illiquid move which is going to give you what I call a manageable reaction, a response. So as always, it's about taking trades at areas I know there's more than likely to be resting liquidity and trading into thin or weak legs in price. Okay, so that's what I want to see, price shitting itself into the level, because you're very likely to get at least a bounce here as a result of the way in which price is moving, because it's illiquid. Some people like to wait for the bar to close, or for something like a pin bar or engulfing candle before they enter. But if I get an approach like this, okay, it's illiquid, it's reaching for liquidity, there are more than likely stops there. I'll often put on half a position as price is breaking the level, or in this case, as it starts to show signs of rejecting. And for me here, that was when it started moving back above these lows. That's normally my kind of trigger for entry. Because for me, it just doesn't make sense to wait for some arbitrary candle close for confirmation. Chart patterns or entry triggers which rely on candle closes are a kind of time factored analysis of how price behaves. But of course, time has very little bearing on the most important thing, which is price and the order flow dynamics which govern price. And once you start relying on time, then just like a definition of the word trend, it's extremely difficult in my experience to ever agree on what does and doesn't constitute a valid pattern, because those patterns will of course change depending on time frame. This is a 30-minute chart, I think. But if I'd waited for the hourly close here, this is an hourly chart. Okay, that's where I entered. If I'd waited for the hourly close here, I'd be getting in all the way up here. So I'm not particularly fussed about hourly closes. What I want to see is an illiquid move through the lows and into an area in which I expect liquidity. Because really, you know how price should respond here. Because the move is so illiquid, it's going to go quickly. Okay, it's going to go quickly. And if you wait for an hourly close, what's going to happen more often than not is you're going to get a really shitty entry, because your edge, the inefficiency, that's already done. Does that make sense? So this is just another example of price running through the highs and into an area in which I expect liquidity to be pooling. And again, this is just a trade plan. I think I've got the actual trade on the next slide. GBP USD again. Here I was expecting these highs to get run. Why? Not because that's where stops are. Okay, nobody's hunting stops, but because the level's exhausted. Okay, whatever was holding price down here, okay, liquidity up in here, that's been rinsed. Okay, it's more than likely that when price gets back to that level, it's going to breach it. Okay, the level's exhausted. Price has hit it 4 times and is now returning to the level, having picked up fresh buyers beneath the range lows. And you can see that here price is kind of reaching for the level. It's an illiquid move. And so having identified a fresh or untested liquidity pocket, in this case, you can just about see it on this time frame, but it was more clear on the M5, which is kind of lurking just above those highs. I wasn't afraid of entering half the position at the level. So this is how I got in here. You can see half as price broke the level with a stop above this low time frame liquidity base, and the other half as price started rejecting the level and began to look like a failed breakout, in which anyone caught long above those highs is going to start unwinding their positions. And I'm comfortable doing that here because, again, as you can see, the approach is good. There's no significant basing just prior to the level getting broken. So there's no significant structure in the kind of immediate vicinity of price, and so it has room to run. I'm likely going to get a manageable reaction here. You can see how that's where I entered. You can see how strong these setups are in the right location. So, as always, I want to see price running thin into the highs. What I don't want to see is price kind of basing out directly above or below the level. Okay. So what I don't really want to see before price breaking out is price spacing out or consolidating before the level gets broken. In fact, this is the scenario I was talking about last week when we discussed volume profiling. Buyers are absorbing at relatively high prices. In that instance, I'm much less inclined to stand in the way of a breakout. And what I'll usually do is wait for this low time frame base to get engulfed. Okay. So again, it all comes back to assessing whether or not price has space to move. Ideally, we want to be trading into thin or weak legs in price, through which price can move with relative ease. And of course, areas of consolidation represent potential sticking points, and you don't want to be trading directly into potential support because there's just no value in the trade. So, as I say, what I'll usually do in this situation, if I'm going to take it, is wait for that area of consolidation to get engulfed, and then I'm quite happy to get in on a pullback. Okay. What we want to see is an illiquid leg through the level. I don't really want to see basing ahead of the level, but if I do want to take it, what I'll usually do is wait for that to get engulfed. And in this case, I'll very often keep my stop above this low time frame base instead of up above the high or whatever range high or swing high you're referencing there. The idea being that trap traders in here should provide some kind of resistance. A trader took on Euro GBP on the M15. Again, really nice level here. There will have been some liquidity above that range high. The reason I took the trade, and in this case, I think I got in either as price started breaking back down below these highs, or when price engulfed this kind of small pocket or base of liquidity. And even though you might think that, well, this kind of this high here is perhaps technically where I'm quote unquote wrong on the trade, I'm thinking in terms of expectancy. Efficient stop loss placement is about identifying where you're very likely wrong, not necessarily on that specific trade, which is what you hear a lot of people kind of tout, I think, betraying really a fundamental misunderstanding of expectancy, but where you're wrong over a series of trades. So I'm thinking in terms of not just win rate, but expectancy. And if your stop loss rarely comes close to getting hit, it's quite likely far too wide in the first place. So here I had my stop just here above this low time frame sell side liquidity, above this small liquidity base, okay, which I would normally expect to provide some resistance when price engulfs it this quickly, and above these range highs. Okay, so I kept my stop there rather than above the bar high. And in this case, even though it did stop me out, okay, so perhaps not the best example, the point is that it doesn't matter that I got stopped out on this individual trade. The point is that over time, keeping my stop there is going to yield higher returns than keeping it above the bar high. Because in my experience, if this is going to work out, really, you don't want to see price kind of trading back up into these levels. So it's worth keeping track of your MAE, your maximum adverse excursion, on trades like these to see if you could be getting tighter stops. And of course, each setup has to be considered on its own merits, but this is really how you maximize your profit over the long term, by by finding ways to increase your risk to reward without materially affecting your win rate. So as I say, what I'll usually do with a setup like this is go down to the lower time frames and find some small liquidity base to tuck my stop behind. In this case, something like that. Or if there's very clear SR like this, above which I really don't expect price to start trading, then I'll keep my stop above that. But for me, the beauty of discretionary trading is that, you know, after years of practice, you can just kind of almost eyeball the chart and identify a spot where you really don't expect price to go based on past experience. So most of the time I'll keep my stop a lot tighter than the bar high because, as I say, in my experience, it's rare for price to come all the way back up here after a failure like that. And this is where practice comes into play. After time, you'll be able to judge based on hundreds or thousands of sample sizes what your expectations are for price. And so rather than keeping your stop at kind of mechanical locations like above the high or ATR or some shit like that, you can really improve your RR by taking this approach. Is that clear to everyone? So, you know, given the right approach and given the kind of order flow dynamics which tend to occur in a break of significant highs and lows, that breakout rush, right? Trap traders getting out. You know that price really should move quickly and with good momentum. So I'm generally expecting a momentum move on a setup like this. And if you don't get that, if price stalls, consolidates, and instead of moving away, it starts consolidating, even pushing back up above the level, that's good reason to reduce your exposure or even cut the trade. So here's one I fucked up. This is the 3K low on Bitcoin last year, and along this here, on this failure, and for some reason I can't remember what I was thinking, but I let it run. I kept the position on, even though price began to just kind of chop around and consolidate down at the low. Really, what you want to see here is for price to move away very quickly. Okay, there's some small pocket of liquidity in there, but other than that, this whole move is relatively illiquid. Given the kind of order flow I expect on a failed breakout, you would normally expect this to move away quickly. You'd get a momentum move, and so I really don't want to see this kind of consolidation, price just stalling, basing out after a rejection like that. But for whatever reason, I kept this one on and got liquidated on the position. I think it was a few dollars off the bottom. It was a nasty one. Anyway, the point is, I'm not usually going to let my price hit my stop unnecessarily in the kind of hope that price might do what I want when the kind of order flow I was expecting, a key component of the rationale behind the trade, clearly isn't present. So it's about having some expectation for price. How do you expect price to move given the circumstances? And if it's not moving as you expect, in this case, just basing out, stalling, consolidating after that rejection, that's generally good reason to as I say, to cut the trade or reduce your exposure, because the kind of order flow you were anticipating just clearly isn't there. So another example here on Bitcoin, what appears to be a breakout failure at the lows, exactly what you want to see, an illiquid move well, there's not much in here actually, but you get the rejection. Price carries on up, but instead of carrying on up here, which is what you'd normally expect, given again the kind of order flow dynamics which occur on a failed breakout like this, in combination with this illiquid move, you should expect a momentum move here. And if you don't get that, if instead of, like it does here, instead of engulfing the nearest potential trouble area, okay, very quickly and then carrying on down, it stalls at that trouble area and then starts trading back into this wick and even back below the low. That's good reason to get out. If there was some significant buying here, price wouldn't have trouble filling that in. That being said, if I do keep the trade on, if I stay in the trade, generally on this kind of setup, I'll be targeting the other side of the range, and that's generally where I'll be taking first profit. Because if price sweeps through one end of the range, there's, in my experience, a high probability that it's going to test the other side of the range and probably take that out too. And there are a couple of reasons why this happens. You could picture it like this: when you're a buyer, you're a seller, okay, and when you're a seller, you're a buyer. So let's say you get short somewhere at the top of this range, in here or somewhere up in here. Anyone who's short from up there, with your stop above the range high and your take profit, let's say somewhere down, I don't know, for many people their take profit will be somewhere in this area. They'll have typically a stop above the range high and a take profit somewhere below price, somewhere in that more voluminous area. If all those shorts get stopped out, okay, what happens? Well, their take profits get cancelled. So if all those shorts get stopped out, there's simply less buy side liquidity down at the bottom end of the range. It's also quite likely that many of those traders waiting for a fill, okay, waiting patiently down at these levels, will have jumped in long up market when price started breaking highs. So their liquidity is no longer down here. Perhaps you've also got traders who see the failed breakout and no longer have conviction in the long side, and so they pull their limits too. Okay, so there are simply less buyers below price, less liquidity for anyone who got caught out up there to offload their longs to. That's why when price breaks or fails to break one end of the range, it will very often move back down and through the other end of the range. So if I'm trading a sideways market, that will typically be my first target, the other side of the range. Generally, some pocket of liquidity flows. But I'll usually split my position in two and leave half on to run, especially if I'm trading with the trend, okay, or we're up at a major swing high or low and I'm anticipating a reversal, okay, because that's how you really grow your account. Not by taking full profit at the first trouble area. So you want to be managing trades efficiently by cutting them early if price is telling you to cut it, and letting winners run if the conditions are right. As always, context is so important. Something that I've found to be true and which I always keep in mind when trading or looking for trades is that the trend will go on for longer than you think it will, as will the range. So expect continuation. And that means trading against people who call tops and bottoms or who trade breakouts early, particularly those who sell low time frame range breakdowns in an uptrending market or breakouts up in a downtrend. So here's quite a nice example from Euro JPY a while back, and you can see that price is clearly trending up here. Okay, so what you want to be doing is trading against both people who call tops early and people who call for an end to the range. Okay, so in this case, you've got quite a clear range here. There's your flag limit. You will have had people shorting this breakdown, expecting for both this range to end and for this uptrend to end, for price to carry on down, to start breaking down. And given the general rule of thumb I just explained, that generally you can expect the trend to go on for longer than you think it will, and for the range to continue for longer than you think it will. So expect continuation. These are the people you want to be trading against. So a nice false break setup there, and price re-enters the range and continues the trend. And not only do these trades have a higher win rate, they will on average also yield much better returns than trying to trade against the prevailing trend, because you can usually hold on to at least part of the position for a much bigger target. So ideally what you want is, rather than fading strong trends, let's say price is trending up, okay, and you get some false break set up, rather than, you can take those, okay, but it's lower probability and often price will just carry on up. What you want to be doing is identifying a trend as soon as possible, and then watching for, let's say we're in an uptrend, watching for false breaks at the lows. So you kind of riding the trend. Does that make sense? So the higher probability, they'll tend to work out more often than trading against the trend, and you can also hold them for a larger target. That being said, I will also look for these false breaks at major swing highs and lows when I'm looking for a reversal, and this is where scale comes into play. What you'll often get is a low time frame range breakout. Let's see, this is something like the hourly, and you've got a weekly level here. Okay, you'll get a low time frame range breakout right into a higher time frame liquidity base. So if I catch one of these, this is one of the scenarios in which I look to fade a trend. Okay, because although you've got, in this case, an uptrend, let's say on the hourly, prices into a weekly or a daily level. So think back to the webinar on scale, the higher time frames kind of take priority. That's one instance where I look to fade a breakout, given the right circumstances, given the right approach. If I catch one of those, I'm usually looking to hold for the swing. So my expectation being that high time frame level will kind of take control, and price will continue breaking down, taking out those hourly levels. So there are broadly three kind of setups, I guess. A range with a false break setup into a high time frame liquidity base after price has been trending up for some time on the lower time frames. Okay, kind of topping pattern. This false break with the trend. So looking for ranges in the context of a trend, and you get the same kind of order flow, stop losses, breakout traders at major swing points. So the same principles apply. The only thing to remember when you're trading swings, false breaks at major swing points, is that you're usually trading against the trend. So here, for example, this is GBP USD, and I think I took this long here on this false break and very quickly cut it when price kind of consolidated at the level, just sat on the lows here, because again, that's not the kind of order flow I want to see. That's often what you'll get when you trade or try and trade false breaks at major swing points as opposed to range highs or lows, because generally the trend is quite kind of strong. Okay, so you can take those, but just remember that you want to avoid really strong trending or impulsive moves into the level, because in my experience these often result in a weak rejection, and after having failed above or below the level, in this case you're more than likely just looking at the kind of consumption of liquidity paving the way for continuation rather than true rejection, and that's not what we want. So I'm looking for a considerable break, a clear break into a very clear and significant liquidity base to take this kind of trade. But as I say, the best opportunities are in a sideways market, and especially in sideways market looking to trade with the trend. So a false breakout of a range in the context of a trend. Anyway, that's about it for today. I hope that's given you plenty of examples. Next week, I think I'm going to go a little deeper and show you some stuff on the footprint, which might illuminate the kind of order flow dynamics we get on a failed breakout, as well as some ways in which you can use it to kind of filter trades and then execute, for those of you who want to go a little further with that.